How should investors think about the total return fund?
The name is really important. The total return fund really is about total return. It's a lower risk strategy within the small cap space. We're looking to find really high quality, mostly dividend paying companies that can also grow over time. We think that when you get some cash back along the way, it helps to take out some of the risk and take out some of the volatility that's generally associated with small cap investing. Now there's trade-off, of course. So in really big bull markets, you would expect that the fund might lag a little bit. In bear markets, you would expect that the fund would do less bad than the market overall. And all that would be in the context of lower volatility and really good risk-adjusted returns. So if someone goes out to our website and looks at some of the numbers and some of the math, you would find out that on a risk-adjusted basis, we've been able to deliver really good risk-adjusted returns. So for the investor that wants to participate in small caps, but wants to take some of that volatility away, total return is a very interesting proposition.
Obviously very topical this year are interest rates. How would higher rates affect dividend-paying smaller companies?
There'd probably be a little pressure on some dividend-paying smaller companies if rates went up, but there are some different classes of dividend-paying companies, and maybe it's a good time to explain a little bit more about how we approach total return fund. Many funds that talk about dividends are out trying to chase the highest yields they can find. We don't do that. If we were going to do that, our portfolio would be loaded with REITs and master limited partnerships and utilities. And in fact, it's not, mostly because those companies are highly leveraged and we try not to invest in highly leveraged companies. For us, dividends are important, but it's not high dividends. It's the ability to pay dividends, the ability to pay dividends through cash flow, the ability sometimes to grow dividends over time. But most importantly, it's the ability for the companies to grow their operating income and compound wealth that way. So relative to other income-producing equity vehicles, we think the total return fund stands a pretty good chance of doing okay when rates finally go up.
How does that help you manage risk in today's environment?
I think it helps in a really good way. I think since we are poised for higher rates, we are ready for the big dividend payers, frankly, to go down. We're not going to face that to the same degree. We're interested in owning businesses rather than stocks, not clipping coupons, compounding wealth over time.